Hi everyone and welcome back to a brand new episode. My name is Marcus and I'll be your host. In today's episode we're going to take a look at Microsoft. If you're new to this channel, welcome. What we do here is that we study and analyze stocks. We go through the fundamentals and the technical analysis of a stock, but we also talk about finance and investing. And if you've been here before, welcome back. I hope you will enjoy this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think and also what stocks you want me to take a look at. Thank you so much. Now let's get started. As I mentioned, we are going to take a look at Microsoft, and they are a technology company traded on NASDAQ. And if we go down to the screen, we can see here that their market capitalization is at $2.2 trillion, and their revenue is at $168 billion. Their PE ratio is at 37 now. Guys, normally I like to take a look at companies with a PE ratio of 20 or below. But having a 37% PE ratio is just too high. But that also means that the market has high expectation of the company. And the risk is that if the company doesn't meet the expectations, we'll see the stock price fall. So 37 is just too high for me. So that's a no for me. Profit margin is at 36%. Now, I like this one. Normally, I like to take a look at companies with a profit margin of 15% or higher, and having 36% of profit margin, I like that. So that is a major go for me. Now, price to sales ratio is at 13. Guys, I like to look at companies with a price to sales ratio of maximum 2. So having 13.7 is just too high. So that is a no for me. Now, price to book value is at 16. I like to take a look at companies with a price to book value of maximum 3. So having 16 is just too high. So that is a no for me. So if we summarize, we can tell that the PE ratio is too high, the price to sales ratio is too high, and the price to book value is too high. So this tells me that the company is overvalued, and we need to see the stock price fall in order for it to become more attractive. But let's continue. So they pay out a dividend of $2.2 per share. I like that because I like the dividend income. Now, the effective return is 0.7%, which is very low. So the dividend, it's a go for me, but the effective return is just too low. So that is a no. Now, the return on equity is at 47%. I like this. Basically, what return on equity means that it tells us about the company's ability to create return on the invested equity. And as for investors, it's very important to see that the company is able to create a return on the investment, on the capital that you invest in the company. So 47%, I like that. So that is a major goal. Now, return on assets, 13.8%. I like that one. A bit lower, but still it's a good number. I like that. So that is a goal. So the stock is traded at $299 per share. And if we look at the 50-day moving average, we can tell that we are trading above, but also trading above the 200-day moving average. This is a clear signal that we might see price move even higher. And if we take just a quick glance on the chart, we can see here that we are trading higher and higher. We are in a positive trend channel, and I see but based on that, we should see a continuation. Now, the price may go down to support levels in order for it to push even higher. But if we are to look at the moving average, the 50-day moving average and then 50-day moving average, it tells us that we should see price go up to the resistance level. Now, we need to be cautious at this area. I'll let you know further down when we take a look at the technical analysis of the stock. But let's continue and go over to the income statement. And the first thing we'll take a look at is that total revenue. We went from $96.6 billion in 2017 up to $165.9 billion in 2020. So a good move, so a great development. We went up to 107 billion, 123, 148, 140 billion dollars per share. I like this one. It has been growing steadily every year. I like this. If you are insecure of what things mean, you just double tap on the text and a description, and a graph will appear with more explanation of what that word means. Now, gross profit went from $62.3 billion up to $115.9 billion and has been growing steadily every year. I like that. Now, the net income went from $25.5 billion up to $61.3 billion, and also we fell off one year and went up, but overall we have had a good positive development. I like that one. Now, let's continue to the balance sheet. What we are interested here is that the current asset versus the current liabilities, and we can tell that the current assets is much larger than the current liabilities, so that is a plus. I like that. They're almost able to pay off their total liabilities, but overall I like this one because the current assets is larger than the current liabilities. Basically, if they convert their current assets to cash, they'll be able to pay off their current liability, so that is a plus. If we look at the total liabilities, we can see that we went from $162 billion up to $191 billion, and has been growing steadily every year. So that is a minus. I would like to see the company reduce their total liabilities, but overall I'm liking what I'm seeing here. Now let's continue to the cash flow, and what we are interested in here is that to take a look at the operating cash flow and the capital expenditure, and we went from $39.5 billion up to $76.7 billion, and has been growing steadily every year, and that is a positive thing. But what we are most interested is that the difference between the operating cash flow and the capital expenditure, and we had a capital expenditure of $20 billion, so basically a difference of $56 billion. I like that, so that is great, and overall development has been looking good over the years, so I like that. Now let's continue to the key figures. And basically what we can see here on the key figure is that the earnings per share went from $3 up to $8, and has been, we fell off one year, but overall has been growing. I like the trend. Revenue per share went from $12.5 per share up to $22 per share, and also growing steadily every year. I like that. Equity per share went from $11 up to $18, and we fell off one year, but overall we are in a good positive trend. I like that. Dividend per share went from $1.5 per share up to $2.2 per share, and also has been growing every year. I like that. I like that growing dividend, that income. I like that. So dividend per share, normally my threshold is that I don't want to see companies pay out more than 60%, because I want to see some of that capital remain in the company for further investment, efficiency, etc. So not larger than 60%. That is my threshold, and we paid out 46% in 2017, 76, which is high, 35, 34, 26%. I like this one. Great job. Now to the profitability, we can see here a gross margin of 64.5% up to 69.8%, and has been growing steadily every year. So this basically tells us that the company is becoming more and more efficient, and that their cost of goods sold is decreasing. So basically, if we look at 2021, is that almost 70%, for every dollar they sell, they are able to keep almost 70% of that dollar. That is great. I like that, and they are becoming more and more efficient, so that is a plus. Operating margin went from $30.9 up to 42. No, I mean 30.9% up to 42.8%, and has been growing steadily every year. I like that. Their profit margin went from 26% up to 36%. We fell off 1 year, but overall, as we have seen before, they're having a good trend. Return on equity went from 29% up to 43%, and we fell off like we've seen here before, but overall we fell off over here as well, but overall a good trend. I like this. Basically, return on equity tells us about the company's ability to create return on the invested capital, and as for investor, you want to see that the companies are able to create a return on the capital that you invest in them. So it's very good to take a look at return on equity. Return on asset went from 10% up to 18%, and we fell off 1 year, but overall we are having a good trend. I like that. Solidity went from 35% up to 42.5%. Fell off 1 year, but overall we have had a good trend. I like that. Solidity basically looks at how much of the total assets are financed by the equity, but also lets us know about the company's financial strength for the short term. Balance sheet is liquidity. It's same thing as solidity, but here it looks at the company's financial strength for the long term, and here we went from 1.3 up to 1.7, and has been improving every year. I like that, so that is a major plus. So, and the debt ratio went from 1.8 down to 1.3, and we went up a year, but then we have then reduced the number. Basically, what debt ratio tells us is that the company here has 1.3 times more debt than equity in the company, and they have been improving their numbers. So I like this. Great. Now we have gone through the income statement, the balance sheet, the cash flow, the key figures, and now over to the most important part of our software, and that is the pillars. Basically, what the pillar does is that it summarizes everything we've gone through and gives you a simple, holistic overview of the company's performance. And if we summarize it, we can tell that the PE ratio is above 20, which is negative. They pay out dividends, which is a plus. The dividend payout is less than 60%, that is a plus. And the dividends have increased over the past 5 years, that is a plus. And the number of outstanding shares have decreased. And this is something a lot of people miss. Basically, when a company buy back their shares, your share of the company grows. And a lot of people also miss that. For instance, they look at the debt and they see, well, this company doesn't bring in a lot of debt. But when you look at the outstanding shares, it's increasing rapidly, and that's a way for companies to bring in capital. So, for instance, they are increasing the outstanding shares and bringing in capital, while the debt is not growing that fast, and they be looking at it as something positive. But here you need to be cautious and look and see that if a company is buying back their shares, it's positive for the investors. But if they are increasing the outstanding share, that's a negative. So Microsoft buying back their shares, it's a positive. I like that. Now, revenue increased over the past 5 years, positive. Profit margin above 15%, positive. Profit increased over the past 5 years, positive. Current assets larger than current liabilities, positive. Solidity increased over the past 5 years, positive. Balance sheet liquidity increased over the past 5 years, positive. And debt equity ratio decreased over the past 5 years, positive. But the total liabilities have grown for the past 5 years, that is a minus. As you can see, guys, it gives you an easy to digest picture of the company's performance, and you can have this tool along with everything we've gone through for only $25 per month, inclusive our analysis page, where we publish articles and video analysis of stocks, but also you'll be able to chat with me alongside other members. So for only $25 per month, it's yours to have. Now let's jump over to the technical analysis of the stock. So here we have the stock, and we shall do a technical analysis of it. And what we can see here, that we are in a clear positive trend like that. Let me just lay down the line and change the color here to red. Let me see, it was already red, and then change. Let me lay down this one and change it to green. And what we can tell here, we saw that the 50-day moving average and the 200-day moving average all signal that we are in a, we might see price move even higher. And we can see that we have been in a trend channel and moving higher and higher. For instance, we have higher lows and higher highs. So basically we are in a positive trend line. But here we saw that we broke out, and then the price fell down to this what used to be a resistance level and now a support level, and then moved up again. So we might see price move even higher here. There is nothing else that indicates that we might see price fall back down into the trend into the channel. So basically what I would do here is wait for the price to fall off and be very cautious here, because this one is now a support line. So basically when the price move down to the support line, a lot of buyers will come in and jump in. So I'll be waiting for the price to fall a bit, touch the support line, and then jump in. But I wouldn't jump in right away, because I would wait and see if the price move up and above what used to be the highest level. And if it does, then that will signal that we have a lot of momentum, and then jump in for higher levels. So that's where I would trade the stock. How would you do? Please let me know in the comments below. And this is it, guys. This is it for this episode. Thank you so much for watching. I truly hope you enjoyed this episode. Please give me a thumbs up, comment, subscribe, and let me know what you think. But also, let me know what stocks you want me to take a look at. Okay? Thank you once again for watching. Until next time, take care. Bye-bye.